All right, good morning, everybody. We have a lot on the table today, including this entire group of Fed speakers. Now, not all of them are voting members, but you can see that the Fed is trying to get a message across. It really kind of stands out that we have so many piled up back to back. It seemed a little bit yesterday that they weren't on the same page. And so it's likely if they continue to be on separate pages, then we're going to, see a market indecisive. But if they all start saying the same thing, the market might finally get whatever message they're trying to put out, and maybe we'll make a move. Speaking of making a move, we have the capacity today to make a pretty good size move. We could see the lack of participation in the later part of yesterday as people really started stepping back and stepping away, unwilling to commit in the later part of yesterday to a new position without getting the information of today. Bank of Japan is still fighting with that new yield curve cap. It went from 25 to 50, and now they're struggling since it had unintended consequences. Tesla's down yet again. And the European central bankers are saying that they are very near to their target rate. We don't have any additional auctions today. So once we get past the IBPMI, the rig count shouldn't be a bother to anybody. It's all going to be anything in the afternoon is all going to be directly connected to any Fed speakers and what those Fed speakers have to say. And we really are looking for that unified message. Continue to keep your eye on that Nick Tamaros guy from Twitter. I hate, talking about his Twitter feed. I'm not trying to promote the guy. It's just we know the Fed leaks through him, or we know the Fed also often clarifies a message through him. So, as much as I don't like promoting somebody like that, it's an account that everybody out there, all the fund managers and everybody knows that this guy is a mouthpiece for the Fed. So I don't know what makes him special in that way, but he's been their leak before, and he's always one that you want to watch, especially with this unprecedented collection of Fed speakers today. So for a 0 day, it's going to be a pretty tricky thing to do. And I would just stress caution, because any of these Fed speakers could accidentally say something, right? We're all human. We can make mistakes. They can accidentally say something that just rocks this market. I've felt what that feels like, to have a position and then just suddenly have everything ripped apart because one of these Fed speakers screwed up. It's not cool. The last speaker will be at 3:30, which will again make it a little tricky because we've got somebody out there nearly every hour. Not much of a window when you know between 1 and 3, it's usually when we get our afternoon trade, that we've got a Fed speaker on deck at 3 or 3:30. To highlight the anticipated severity this morning, you can see the lower volume. We're below that 100,000 level. It's not a surprise that we're below that level because we know we have some very serious econ this morning, but we would use this gauge every day. And if there wasn't something that we knew on deck and we were below 100, that would cause us concern. We'd want to go out and try to find what is it that everybody is standing back, standing away from. Since we know what it is, we just turn that thing off, get it out of the way. The market tried to reset yesterday and get back up to where the cash open was. It didn't quite make it, but it sure gave a run for it after the market opened back up. So, we had a relatively decent initial balance, didn't really go anywhere. We're still sitting in that zone, which I happen to point out, it's a very tight zone. It's not much of a surprise knowing that, we've got this serious economic agenda this morning, but that's a tight range. The range continues to tighten and tighten and tighten, like we were talking about quite a few times. Still got the levels that we drew yesterday. When we finally leave this range, it is likely to be significant. Just keep in mind, it does not owe us a big move, right? It doesn't owe us anything. We could just go into the close today, right where we are, still sitting inside this range. I find it hard to believe that that's the way things are going to play out, but we'd never want to do something that says, well, price can't do this. Price can do whatever it wants, including just holding the range. Here on the weekly chart, it demonstrates the severity of this IX10 pattern that we're in between 37.88 and 39.20. So 37.90 to 39.20 is an easier way to say it. We have a market maker move this morning. We can see that the front end of the curve is higher than the back end of the curve. Otherwise, we wouldn't have a market maker move. The 21-day average daily range is 2%. And they're saying right now, between right now at this moment and to the end of the day today, we have the capacity to move another 1.2%. So for the day, just today only, they're saying we could move 3.25%, and it wouldn't even be an outlier event. It wouldn't even be a surprise or a shock. It's not reaching at all, which means if we move more than 3.25%, say 3.5 or 3.75 today, we would only just begin to touch on the fringes of what would be considered an outlier move today. One of the statements that I made yesterday going into the close is, I hope you like what you have in your portfolio and that you're comfortable with it, because by the time the market opens this morning, your position could be significantly deteriorated, or it could be, doubled in profit. It's a little bit of a roll the dice thing. I don't like rolling the dice. Trading should be trading, not gambling. So let's just go ahead and mark out a 3.25 move. That gets us really close to 39.60. So I'm just going to go ahead and and mark 39.60. Of course, we got to do the same thing in the other direction. And that's really close to 3,700. Now I have to kind of reach for 37. I really think if we get that close, though, we're going to go to it anyways. 3.25 is 37.07. And 3,700 flat is about a 3.5. But we're going to do that because if we get that close to 37, we're going to go to 37. So that's some pretty solid levels we've got there. Go in and add the 50% of the move. And now we've got a few more levels. Split everything in half. It's very likely that they may be poised for something like a plunge protection behavior. What I mean by that is, so there's this thing called the plunge protection team. I think it was something that was put together in like the 80s. It's been around for a long time. And when the Fed wants to, they can change the direction of the market. If we're going down really hard and it's starting to freak everybody out, they can stabilize us off the lows and often ends up popping us back up off of those lows. And if we're going up too fast and they don't like it, they can turn around and dump us back down again. An example of that downward move is the Jackson Hole speech that was given last year when Powell did that mic drop moment and sent the market on a tailspin 10% to the downside. And when I was newer, I used to think that they were trading something to make this market move because we'd hear about it all the time. Oh, the Fed manipulates the market. They make it go up. They make it go down. And I thought, man, that'd be such a waste of money to go out and have to buy all this something to make it move. They're not buying anything. They don't have to. All they got to do is come out and open their mouth and chip teeth. Well, they're lined up today to do exactly that. So if they want to, they can move this market in whatever direction they want. They may be poised to try to stabilize something. So some news coming out, some anticipated impact that they know about that we don't, that is coming out today, and they're prepared to try to slow it down. In the last 6 weeks of 2022, I continued to mention there are two threats to an upside move. It sounds funny to say it's a threat to the upside, but most of us are positioned short. So if the market was to make a 10% move to the upside in 3 days, that would rip a lot of our positions apart. It's a serious threat. There's two threats to the upside. One would be if China just threw open the doors and said, screw the COVID zero policy, we're open for business. That would send this market ripping to the upside. And they haven't done that. They've slowly opened things back up again. So we avoided that one, at least so far. And the other one that I continued to mention is if the Ukraine situation was to get a significant change from the stalemate that we were in. Neither side was willing to compromise. Neither side could get anywhere at negotiations, and neither side was backing down. Now there's talk about a truce. Now, granted, only one side is saying it and the other side's ignoring it, but it's a start. And that kind of news, if it turns into something more, right? It's supposed to be like a one-day ceasefire. If it was to actually begin and then perhaps linger and last longer than a day, the changes to the market could be severe and extreme. Talking about a significant upsize move. Those two threats are still the two most significant threats to the upside move. There's still a lot of shenanigans going on in the Japanese market, and that continues to bleed over around the world. So we've got to keep our eye on those FX pairs. For today, it's all going to be the job numbers this morning and then the Fed this afternoon. No other thing matters. Ten-day, 30-minute volume profile. We've shifted enough now where the point of control is nearly dead center in the middle. We still have that classic D shape, but we are starting to lose a bit more of it with this volume node around the 3911 cog line and a little mini one down here at the 3811 cog line. A cog line is not a structural level of support or resistance. Neither are these value area highs and lows. Even the red line where the point of control is at, it's not a support or resistance line. It's just an area where we could anticipate a reaction in price. When Econ comes out, the move is usually very fast and very violent. Nothing like a pivot point is going to slow it down. Cog lines, pivot points, nothing like that. It's going to go until liquidity is done. Now, it's worth noting that when we get these pre-market Econ moves where we set an extreme high or an extreme low, what we very often do through the rest of the day is unwind that move and go back to the starting point. I call it a gap close, even though you can see candles in there and it doesn't look like a gap. I still say it's a gap close. We're looking at the 5x5 here. We don't have anything to carry forward. So there's no, untouched point of control or anything like that that we need to bring over. There is a VPOC to the downside at 3790 area. And I believe there's one far enough away, to the upside at 4076. Those are outliers. Even if we were to reach them, they would still not be support and resistance. They're just levels where we anticipate a reaction in price. So someone asked the question about, well, after the market does reset that gap, couldn't it then continue to do whatever it was doing? Yes. So say it makes a big move to the downside and then the market opens and we go back up and get that gap closed. It could then fall right back down to the downside. And a lot of times that's what it will do, right? It'll continue the directional move that it had originally started. It just needs that gap closed first. One of the ways to learn how to find a way to trade it is to find it. So the 13th of last year, 13th of October, 13th of November, the 11th of December, these economic days are ones you want to keep track of so you can go back and kind of remember what that looked like. Here on Tuesday was the CPI right before the FOMC Wednesday. And in the pre-market that morning, we had a Econ come in at 8:30, spiked to the upside, and we set that high. The market spent the rest of the morning coming back down and closing that gap. And then it dumped through and came back up again, yet to that same spot by the end of the day. But getting the gap closed would be looking at where we were at 829 and then where we end up after the first initial push and focusing on getting back to that gap close. It doesn't always close, right? I know it closes most of the time, but nothing is 100%. Nothing always does everything. The only promise the market makes for always is it was always willing to take your money, right? So that's about the only promise I know the market keeps on a regular basis. So if you want to learn more about how to trade something like this, you want to go back and find all of those economic events. Every morning in the morning briefing, I show this. One of the reasons I do that is because if I want to go back and look at a day, say June of last year, June 18th, I can go to the morning briefing of June 18th and I can look at what was on the economic agenda that day. And that way, when I'm looking at June's 18th candles, I know, oh yeah, by the way, there was a lunchtime auction at 11:30 and we had, non-farm payrolls that day, whatever it happens to be. So when you're trying to identify what's going on in the candles, looking back one day, that's not too hard. We kind of remember what happened yesterday. Trying to remember what happened a year ago, forget it, right? And understanding the moves that we see within the daily candles, if you don't know the econ, how can you understand the move? Why did the breakout work? Why did it not work? Why did we V bottom or V top and turn around and go the other direction? If you don't know the econ of that day, how can you understand the price action of that day? You can also Google when was CPI 2022? When was PPI 2021? You can go back years doing that. Mark it all out on the chart. So that if you want to study it more, you can deliberately pinpoint when those days were. Like this one. So we're expecting a big move at 8:30. That's very likely going to be one solid initial push. And then our expectations would be that we close the gap. It's closed the gap for the last 4 months consistently, which begins to make me a little nervous. Because at some point, where's that outlier come in? Where's that one day where we don't close the gap? We're due. Is it going to be this time? So, we can't just automatically assume that it's going to close that gap. But that's the baseline bet because that's what it does more often than not. Every Friday morning, we look at this range and we look at the new range. Now, the new range is not set in stone yet. Throughout the day today, this new range is going to continue to move up and down and expand and contract. And after the market closes today, then it's going to lock into place. Until then, it's not technically valid yet, but it's usually a good starting point for whatever the Fed is doing, or at least for whatever the market makers are doing. So we can see that the econ anticipated this week is more than the econ anticipated for next week. Now, as far as I know, next week is a full week. Yep, it's a full week next week. So when we're sitting here looking at next week's range, and it's smaller than this week, which was only a 4-day week, it shows a lot less volatility than what this box is representing, right? Sure, we can see visually that the box from this week expands much wider than next week's range. But this week's box was only a 4-week box. So less days, more volatility. Next week, we got 5 days and less volatility. So they really dial it back next week. I don't know about you, but the market still feels pretty violent. Volatility is often based on candle close, right? If we were to go out to the daily chart and bring up something like the volatility indicator, they really should have named this something else, because this thing isn't looking at options. It's looking at the candle close. It's a historical movement indicator, measuring how far we went from one day's close to the next day's close. That's all that's doing. So when we say volatility equals movement, that's exactly what we mean. How far did we move? That's what this thing is recording. So right now it's saying that volatility is compressed. Volatility is not very significant. And that makes sense because we haven't done anything for a week. We've been doing this. We're in that IX10 pattern. But that doesn't mean that it's not volatile out there. And we're getting big moves in the intraday. That's why we continue to have an ADR near 2%. You know, pre-COVID, we had an ADR of what, like a third, 0.75%. So we're going to look to resolve this range this day today. If for some reason we end up still inside the range opening up next week, we'll deal with that. Otherwise, we want to focus on what's the ramifications of leaving the range. It's very unlikely that we're going to break out of the range, either up or down, and then come back in again, right? So we're talking about like a fake out breakout. If we close this week below this range, next week we should stay below it and should not come back inside of it. And if we close this week outside the upside, same thing. We should stay above it, not come back inside of it, not next week, later. China ADRs are down, natural gas, and Bitcoin. And bonds. Just go take a look at bonds. All right, bonds are down about 40 cents. It's really trying to hold big gappy bugger though. This thing moves just as much at nighttime as it does during the day. So we had that pretty solid run up. The retrace is kind of what's important. The fact that it closed below the 50% line on this retrace calls into question the idea that this could be, you know, this the beginning of a turnaround in this trend. So when we zoom out a little bit, look at it in a greater context, I want to continue to focus on these swing high, swing lows. For a trend to be valid, you need 2 higher highs and 2 higher lows. Call it a full set. Well, at the moment, we don't have even 1 higher high if we're focused on this previous point back here. Now, technically, we don't need that, right? We could set a high, we can set another high. That would be a full set. Even with that, until we get above this pivot point at 120, we would not be safe with any longs if we wanted to be consistent in our approach, right, of looking for a solid turnaround. That doesn't mean we have to wait to be able to trade, though, right? And we could bring that down to 110, depending on what this price action does over the next 2 or 3 weeks. It would make this 110 area become the new 120 area. But for right now, 120 is that line that we need. So for the moment, it needs to hold above 92, the low of the year. Now that we've turned and started to go up here, it cannot drop below 100 and close below that. Otherwise, this lower high gets taken out and we have to start focusing on that previous low again. We've been seeing stocks and bonds moving in the same direction. It's why it's worth taking a look at bonds. They work together for a little bit and then they decouple. They come back together and then they decouple. There's been times throughout history where the coming together and moving in a correlated state happens for more than just a couple hours. It happens for weeks at a time. It's not normal. We don't normally see stocks and bonds moving in the same direction, but we're going to continue to see a lot of changes in the first quarter here. US dollar Canada. It's a very solid run this morning. This ties directly in with energy and commodities. So you want to keep your eye on that. US dollar Japan is going to tie directly in with the moves in gold and silver that we've been seeing. So watch the clock today, guys. Keep track of something like FX Street. If you've got paid services, news services somewhere that could do better, then by all means use that. But if you're running on a free news service, this place is pretty fantastic. It has a filter that you can go in and filter out the news that you don't want. Like it has CNBC in it. I don't want news from CNBC, so I turn that off. So it's kind of nice as an aggregate news source. This thing is aggregating news from all over the place, but you still have the choice of going in and turning off what you don't want. When these Fed speakers are talking today, Finance Juice is going to be posting what they think is significant, and they will highlight it in big red blocks. You can't miss it. So it really kind of gives you an idea of why price is moving in this afternoon, who's speaking, and what kind of things are they saying that's rocking the market. So nothing else is hitting our benchmark this morning. We kind of keep a line in the sand of something moving at least 0.5% for it to be something worth looking into. Sector wise, nothing's really hitting that level. Just looking at some of the names that have moved this morning, Tesla's on that list. I think Apple had some news again this morning. Oh, a lot of those defensive names are getting whacked, like Pepsi. It's a significant reversal off of the highs. Healthcare names. Watch Tesla when we get around $100. It is a psychological level. Very often when we get too close to it, it will become a gravity point. We'll just go to it. It would not surprise me at all if we see that level defended pretty solid. Round numbers always are areas of concern that you want to watch. The $100 mark is even more so. There's been some good books written on this over the years. If you were to go out on Google and type in, just use some keywords, stock market, $100, psychological level, trading level, you use words like that in your Google search, you'll find there's a lot of white paper research. If you go to, say, Google Scholar, you can hit, YouTube, obviously. People do crazy stuff and people are lazy, right? So a nice round number, putting orders in at that level, there's a lot of reasons behind it, but we're getting close to it. It is a level of concern. It has an anticipated impact, and it's very likely a level where there's a lot of liquidity. It's not alone. Amazon also is down this morning. All right, so Costco's up because of this news report on sales. At least they're not up from job cuts. And we are starting to see analysts come out more with their revisions. It's something that I've seen them kind of getting basically laughed at on some of the major outlets. Bloomberg, Reuters, Wall Street Journal has even mentioned it. Remember, with these analyst rate changes, there's supposed to be something behind it, right? Either a small paragraph, an article, an explanation of why they adjusted things and what their new target is. I don't bring it up because you should trade what they say that's a really bad idea. It's usually, though, that their research has highlighted something, right? A change in company structure, company supply chain, a change in their financials, some reason to give an upgrade or a downgrade. Those reasons can sometimes be eye-opening. Give you a better understanding of what that company is struggling with or how good they're doing compared to their peers. You can find analyst rate changes on Thinkorswim just by going to use the news, scrolling down to analyst rate changes. Trade Flash is partly made up of reports from a company called Hammerstone or Hammersmith, which is a crazy expensive monthly subscription, but you can get some snippets of that for free by keeping your eye on Trade Flash. It has all kinds of stuff in it. A midday analyst rate change can often be a game-changing move intraday. Otherwise, they'll put in things like big options trades, big dark pool prints, all kinds of stuff. So, it's free. It's right there. It's worth keeping an eye on it. And if you need to, you can search for names in it. You see a big move on something like Costco, you can go in and type in Costco and see if it has something in there on the why behind it. All right, VVIX is still sitting at this significant low. $75 is like a benchmark line in the sand. You can look back for years and find one print where we were below 75 or right at 75. So it's kind of a really big deal. The VVIX, it's not, I always refer to it as the volatility indicator of VIX. Imagine putting on an implied volatility indicator on SPY like I did earlier. Well, you can't put an implied volatility indicator on the VIX. That just wouldn't make sense. But if you think about it, this is the implied volatility indicator of VIX. Technically, that's not exactly what it is, but it's the easiest way to explain what it is. All right, so just kind of imagine that that's what we're looking at. If this is the implied volatility level of VIX, this is saying that the VIX is not very volatile right now. And if you think about it, since the VIX hasn't been making big, sweeping, massive moves, then I guess that thing is kind of right. The VIX is not very volatile right now. It's holding between 20 and 34. Generally speaking, though, with the way things work, when we go through periods where price is not making big moves, and then we suddenly change from that and start seeing price make big moves. So that's our expectation with VIX. is that we're very likely going to see a significant change in the VIX soon, because we're getting to a level where that lack of movement causes compression. And like I've continued to say, if you compress the market, it will explode. One good thing to note is, if you think about it, from COVID last year, we really got out of those COVID levels, right? We had that significant change when COVID came in and completely readjusted VIX as the structure of VIX. And then over the last year, it's really fell down. But there's still the problem of the front end of the curve. One of the reasons that the VIX isn't moving is because everybody is now trading the front end of the SPX. 0-day options account for more than 50% of the options volume. Everybody's in the front end, even the institutions. There was this really great Tasty webinar where they brought in this really awesome science nerd. The guy was a professor at one of the local colleges in Chicago, I believe. What they were coming up with is, who's doing the trading on that, right? Is it really all just retail? Because that's what they usually say, you know, if the front end of the trade is happening, it's probably retail. Because it's hard to imagine a firm using the front end to hedge anything. And since firms hedge more than trade, it would make us believe the front end of the trading isn't from funds and firms. That science dude kind of argued against that and said the flow is just too much for it to be retail, and that it's very likely institutions. But he wasn't able to specify what the game change is. Why are institutions trading in the front end like that? How are they doing it? What's their end goal? There's still going to be a lot to be said about how options are traded now that the SPX has 5 expirations in a week, right? And not just the SPX, but we've never had it before. And just like with Japan making changes and having unintended consequences, well, the CBOE and everybody else brought in those 5 days a week now, and there's still going to be unintended consequences. And they still don't know the ramifications of it. I would say continue to keep your eye on the VIX. And as I've said before, when the VIX is low, buy it. In the current market conditions, if the VIX is low, just buy it. It won't be much of a hedge because it hasn't been much of a hedge, but it's more of just making a trade, right? Buy low, sell high kind of thing. The thing is, though, if you're going to do that, remember that it expires on Tuesday. So at the end of the day on Tuesday, you can't trade it anymore. On Wednesday morning, when the SPX opens, that option that you traded in the VIX will be gone. So European expiry is what they call it. And the other thing is, if you're not trading in the front month, then at the money isn't at the money. You have to go look at the options on the futures, or you have to go look at the futures contracts. So for VIX, right now, it's the options chain that I'm looking at. If I wanted to trade the March series, I'm out 2 months. So at the money is not at the money. Current VIX price here at going into the close was 22.88. That would make me believe that trading 22 or 23, that these options would be at the money. They are not. And that's because these options are not looking at the VIX. These options are looking at the VIX futures for March. So we'd have to go to the VIX futures, go to March, look at the March price, 24.32 is at the money. Go back to VIX, go to March, 24.32. So that would be using between 24 and 25. There's at the money. For these VIX trades, out of the money always feels better because they're cheaper. But with these, unless we get a COVID style significant massive monster move above, say, 45, any of those out of the money calls that you buy in VIX expecting a payout from a big move, they're not going to monetize. You'll be lucky to get out of them at break even or just take a little bit of a haircut. So you got to trade at the money in these things, because it's very unlikely we're going to get that big of a move, right? We haven't had that big of a move since, well, COVID. I heard a lot of analysts say that the bull run in the dollar is done. I've also heard other people say, nah, it's just on a pullback. Like Tom always says, if you don't like the trade, take the other side. If this is just in a pullback, that's a pretty significant pullback. I don't think that we're going to just automatically reset and get back down below 85 anytime soon. But it's hard to believe that just blindly staying strong, long in the bullish and long in the dollar is a good play, not blindly. You know, there's always that idea of the macro trade versus the signal or the pattern or the reason to get in. A breakout, an expansion, a Busby, something. Versus, oh, well, we're just going to be expecting the dollar index to stay bid, so we're going to get long. The 105 is still the benchmark, though. This did stabilize, and if it does begin to turn around and start moving back up, we got to put a level on it. So, you know, start with, say, 108. If the Dixie gets above 108, we're very likely going to leg down to the 2022 lows in the S&P. If we get above and close above 108 on the weekly, start pushing towards, say, 111, 112, we're very likely going to see a new low in the S&P and the NASDAQ, lower than the 2022 lows. So that would get us to those lows, maybe wick us through a little, but not really see a significant leg down. And if we get the dollar above 115, then we're talking about seeing the S&P get down to a round number, 33, maybe 34. We're talking about a whole new leg down here, getting back towards where we were right before COVID kicked. All right, guys, it's really close to the Econ. I'm going to stand aside and get out of the way. Everybody, please be very careful today. Watch the news, watch the clock, and have a good weekend. I'll see you.